Let's take a look at convertible bonds. So a convertible bond is a bond that can be converted to the company stock if the bondholder chooses to do so. Why would a company issue convertible bonds? Well, you might have a company that is a young company, it hasn't established much of a credit history, and it has to pay a very high coupon rate to issue debt. So, just for example, the company might have to issue debt at a 15% coupon rate, but if they issued a convertible bond, they might be able to pay 6% because the bondholder says, look, I'm going to get 6%, but if the value of the stock takes off, I can convert and I can, cash in. So I'm willing to accept a lower interest rate. So a convertible bond is similar to a bond with warrants. In a previous video, I discussed the concept of warrants, and a warrant is a call option on the company stock. But the difference is that the company will issue new shares if the warrant is exercised. And the difference between the bond with warrants and the convertible bond is that when you have a bond and you have warrants, you can separate out the two, and you can, for example, sell the warrants separately or sell the bond separately. In a convertible security, you can't do that. The value of a convertible bond has three components: the straight bond value, the conversion value, and then the option value. There's an option to convert. You don't have to do so if it's not beneficial, but if it is beneficial, you can choose to do so. So let's take a look at an example. Suppose we have a company, Fast Grow Inc., and it just issued a zero coupon convertible due in 10 years. Let's say the conversion ratio is 25 shares. So you can convert your zero coupon convertible to 25 shares of the company stock. The appropriate interest rate or discount rate is 10%, and the current stock price is $12 per share. Each convertible is trading at $400 in the market. So let's try and figure out what the straight value of the bond is, what the conversion value is, what the option value of the bond is, and what's the stock price that makes the conversion value equal to the straight bond. So the straight bond value is just the present value of these cash flows. This is a zero coupon bond, so 1,000 divided by 1.10 raised to the 10th power gives us 385.54. What's the conversion value? You can convert your shares into the stock, and if the stock is selling for $12 a share, if you converted right now, you could receive 25 shares times $12 a share, or $300. So what's the option value worth? The bond is selling for $400. The straight bond is worth $385.54, so the option is $14.46. That is, people are willing to pay $14.46 more than the value of the straight bond because of this opportunity to convert to shares of the stock. And at what price will the conversion value equal the price of the straight bond? It's the straight bond price divided by the conversion ratio. So it's 385.54, that's the straight bond price, divided by 25, or $15.42. Let's see what this looks like graphically. The value of a straight bond is not very interesting, right? This is just the value of the bond. In this case, it would be 385.54. And it doesn't vary with the stock's price, right? It's just the same value. Let's toss in a conversion value. So here you have the opportunity to convert into shares of the company stock. The slope of this line here is the conversion ratio. And you'll notice that before we have a floor of what the bond will be worth, the first part of the floor is the straight bond value. Once you get to the point where the price of the stock has risen enough that it's valuable to convert, that the conversion value has value, then this goes up. This looks like a call option, right? With the strike price here at this break-even point. And this sets the floor for the value of the bond. Okay, if it was just a straight bond, it would be this flat line. But because now it has crossed, or if it crosses the correct stock price, right, it's high enough stock price, the conversion has value, then you have this option to convert. And again, this looks very much like a call option. Let's put the third part of the picture in, which is the option value. So if you've studied options before, you probably have seen that, this hockey stick part, this dashed line here, is at expiration. But an option will have, a call option will have value greater than this intrinsic value here, because there's always a chance the price will go up more and you can cash in. So the option has value here. Okay, so let's look at what we have from our example graphically. We figured out the straight bond price at 385.54, so that's this flat line here. We figured out the conversion value, which is 300. Right, it was $12 times the 25 shares, $300. So this is out of the money. Okay, you're not going to use it. The price of the bond is 400, and the price of the bond is 400, and the straight bond value is 385.54. So this is the option value, this 1446, and we see here that the break-even value is 1542. That is, the price of the stock has to rise above 1542. You can think of that as sort of the strike price in order for this to have value. So what does this look like if we change the conversion? What happens to the conversion value with a higher conversion ratio? What this does is it shifts the curve back, or it shifts this line back. The line here, this conversion value, the slope is the conversion ratio. If we have a higher conversion ratio, we have a steeper slope. And so, for example, suppose the conversion ratio is 50 instead of 25. Now the break even is 771. So it shifts it back. Of course, if you had a lower conversion ratio, let's say 10, I didn't draw that in here, okay, then you would have to get to a price of what, 38.55 in order to break even. So you can see that there's value perhaps in owning a convertible bond. And again, the reason that companies issue convertible bonds is that usually they can get a lower coupon rate than they would normally get by giving investors some upside should the company do well. Okay, quite a few years ago when Amazon was a young company, I remember reading that they were issuing convertible bonds and the coupon rate was very low. But why were people willing to accept such a low coupon rate? There was some hope that the company would do well and you would be able to convert your bonds into shares of Amazon stock. Turned out to be probably a pretty good deal for those who bought the bonds, because Amazon has become, such a behemoth and quite successful. Okay, other companies, perhaps the option expires worthless, that the price does not rise above the break-even point. So I hope this is helpful in understanding convertible bonds, and thanks for watching.